Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about SHENZHEN International Holdings Limited annual report. SHENZHEN International Holdings Limited is a diversified investment holding company that provides a wide range of businesses and services. At its core, the company focuses on logistics infrastructure facilities in China, operating through three main segments: toll roads and general environmental protection business, logistic business, and other ancillary services. The toll roads segment develops and manages toll highways, while also engaging in wind turbine equipment sales, kitchen waste disposal projects, and wind power station operations. The logistic business segment constructs, operates, and manages logistics centers, integrated logistics hubs, and provides third-party logistics services, including financial services, port and related services, and logistics park transformation and upgrading. In addition to these core segments, the company offers a range of ancillary services, including electronic information exchange, supply chain management, project investment consulting, real estate development, construction and operation of expressways, logistics and transportation services, cargo transportation and warehousing, and wind power generation systems. The company also invests in and operates wind farms. Overall, SHENZHEN International Holdings Limited is a multifaceted business that provides a broad range of services to support the growth and development of China's logistics infrastructure. SHENZHEN International Holdings Limited maintains a market capitalization of 18 billion, broadly in line with the industry peer group. SHENZHEN International Holdings Limited trades at a higher price-to-earnings ratio of 8 times and a lower price-to-book ratio of 0.49 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced. Investors should evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap. The leverage on the balance sheet appears elevated, with liabilities of 60% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The company have a dividend yield of 6.42%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, the logistics business has seen significant growth, with an increase of $4.29 billion in 2025 compared to 2024. This is also reflected in the port and logistics park services, which have experienced a growth of $370 million. The head office and upgrading functions have also contributed to revenue growth, increasing by $11.84 billion. Another significant driver of revenue growth has been the increase in toll roads revenue, with a 2% growth from HKD 44 million to HKD 12 billion, 174,631,000. Additionally, the company's logistics park transformation and upgrading business has seen a 35% increase due to improved leasing conditions. The port and related services business have also experienced a 13% increase, driven by increased revenue from port supply chain business. Furthermore, the attraction of tenants from the cross-border e-commerce sector and the successful operation of SHENZHEN intelligent logistics hubs have contributed to revenue growth. The expansion of operating area, increase in intelligent cold storage and ambient temperature intelligent warehousing, and logistics parks in Guangdong province have also seen significant increases. On the other hand, the primary drivers of revenue decline include entrusted construction management service and construction consulting service revenue, which has experienced a 30% decline. Additionally, toll roads and general environmental protection services have declined by $246,000. The company's logistics parks in other regions of China have also seen a 2% decrease. The intensifying competition within the domestic civil aviation market, shift in passenger demographics towards more price-sensitive travelers, and substitution pressure from the high-speed rail network have all contributed to revenue decline. Net income and profit margins experienced significant fluctuations over the period. Initially, net income increased by 11% due to the recognition of profit after tax from land consolidation. However, this trend was short-lived, as net income decreased by 95% in 2024 due to the absence of profit after tax from the injection of logistics hub projects into ChinaAMC Shenzhen International REIT. Profit margins also underwent changes during this period. The logistics park transformation and upgrading business saw a revenue increase of 35%, while the port and related services business experienced a decline of 35% due to intensified competition, ongoing nurturing stage of new projects, and increased depreciation and amortization costs. Furthermore, the absence of profit after tax from the injection of logistics hub projects into ChinaAMC Shenzhen International REIT led to a significant decrease in net income. Additionally, the loss attributable to shareholders for logistics services business increased by 295% due to various factors such as intensified competition and increased depreciation and amortization costs. The overall decline in net income can be attributed to several factors, including decreased profit margins, increased expenses, and absence of profit from certain projects. These changes highlight the complexities and challenges faced by the company in its operations and financial performance. The company's financial performance indicates a positive trend in its operating cash flow. According to the provided information, the company has consistently generated positive operating cash flow in 2025, with a notable figure of $234,119 on page 3. This is further reinforced by statements on pages 14 and 53, which confirm that the company's operating cash flow is indeed positive. The substantial net cash generated from operating activities, amounting to $4,515 million, as mentioned on page 53, underscores the company's ability to produce a significant surplus in its operating cash flow. This suggests that the company has effectively managed its operations and is generating sufficient cash to cover its expenses and investments. Overall, these indicators point to a positive operating cash flow for the company. The performance of various segments and regions within the logistics industry has been analyzed, revealing both strong and weak areas. On the positive side, logistics businesses, toll roads, port, and logistics park services have shown good results. The China region as a whole has also performed well, with notable success in instant retail and emerging industry sector, green logistics, low-altitude logistics, and digital logistics sector. Additionally, niche sectors have demonstrated strong performance. Furthermore, specific cities such as Beijing and Shenzhen have excelled, while logistics parks in Guangdong province have also shown good results. The logistics services business has also been a standout performer. On the other hand, some areas have struggled. Head office functions and related services have underperformed, as well as logistics parks in regions outside of Guangdong province. Management is optimistic about the company's outlook and strategy. The key areas of focus include deepening strategic deployment in inland port networking, logistics parks, air cargo, and railway freight logistics infrastructure, as well as accelerating construction and expansion of intelligent and cold chain projects. To drive growth, management plans to pursue external investment through equity investment to cultivate new growth engines and jointly explore high-end logistics value-added services with partners. Additionally, investments will be made in the intelligent logistics and airport industry chains through a joint fund. In terms of capital operations, management aims to refine its operations to drive cost reduction and efficiency, revitalize existing assets through investments, mergers, and acquisitions, optimize asset structure and cash flow position, and improve financing structure and diversify funding sources. The company is also expecting significant capital expenditures for 2026, amounting to approximately RMB 8,500 million, equivalent to $9,500 million. The company's financial performance has been marked by a commitment to rewarding its shareholders through dividends. As evident from the proposed final dividend of HKD 0.46 per ordinary share, the company has consistently demonstrated its ability to generate sufficient profits to distribute among its investors. This decision to pay dividends is further reinforced by the actual dividend payouts, which amount to RMB 22.12 million. This significant payout indicates that the company's financial health is robust enough to support such distributions, providing a clear indication of its commitment to shareholder value creation. While there is no information available on share buybacks, the emphasis on dividend payments suggests that the company prioritizes rewarding existing shareholders over repurchasing shares. Concerns about inventory buildup and supply chain disruption are evident in the logistics industry. A significant decline in revenue from logistics businesses and parks suggests a decrease in demand, which can lead to inventory buildup if not managed properly. The profound adjustments made by the industry due to geopolitical tensions and global supply chain volatility further indicate potential disruptions. The data from Nanjing Ziba Port is particularly concerning, with a 27% decrease in total throughput in 2025. This decline in port operations can have a ripple effect throughout the supply chain, leading to delays and inefficiencies. The diversion of bulk cargo from traditional waterborne routes to rail transportation also adds complexity to the logistics process, potentially exacerbating existing issues. These developments suggest that inventory buildup and supply chain disruption are real concerns for the logistics industry. If left unaddressed, these issues can have far-reaching consequences, including decreased efficiency, increased costs, and reduced customer satisfaction. That concludes the financial summary for Shenzhen International Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.